Dan, thank you for being with us. Start off at the top. How did you get interested in the international side?
Well, boy, that takes us back many years to Chicago in the late 90s when I met a gentleman by the name...
Some of us, that's not so long ago.
Point taken. So back to the late 90s when I met a gentleman by the name of David Harrow, who manages the international value business for Harris Associates, the Oakmark family of funds.
Sure.
And I was trying to get into the buy-side investing business and met David, and he ended up giving me a job. So it was the only job offer I got, and that's how I ended up on the international side.
International and global, you have two funds. What is the difference between the two? One includes the U.S. and excludes the U.S., is that?
That's right. So global is effectively the entire investment universe, including the U.S., and international is the universe minus the United States.
And indexing. We all know from Jack Bogle and Burton Malkiel and others, why try? Why not just go on the index and ride the wave?
Well, I just refuse to believe that there's not a return on hard work, judgment, and experience. So I believe if you have a sensible, rational economic framework for investing and you apply that with a lot of labor and a lot of passion, and you do so over a long period of time, presumably your judgment gets better and better. I think that there are real returns to be gained from that.
Value investing, how do you define it? Everyone wants to say, I'm a value investor, but what do you bring to the table?
You're right. It's almost a meaningless term, because value is a judgment, and the judgment, of course, is in the eye of the beholder. What is value for one is not value for another. The way that we think about value investing is we're looking to buy businesses that are cheap relative to our independent research conclusion about what a business is worth over a long period of time. And in addition to that being the fundamental principle, in other words, that drives our return, that's the most important thing, buying a business at a discount, we also add on a few other characteristics. And I'll explain those characteristics, but the reason for those characteristics is that we think that value investors make some fairly common and fairly repeatable mistakes.
Is that the value trap?
That is the value trap. I'm sure we'll talk about a couple of my own value traps later on in the interview. I look forward to that. But the repeatable mistakes we make is in this pursuit of finding a business at a bargain price, we value investors very often end up gravitating towards troubled companies, or we end up gravitating towards highly leveraged businesses. And often those businesses have low multiples attached to them, and that's what attracts us. But the problem is that if a business is under pressure or if a business is highly leveraged, as you move through time, the competitive pressure or the volatility of the economic environment in terms of the leverage working against you means that over time you may end up thinking you bought the business at a cheap price, but it ends up that what you thought was a cheap price at the entry ended up not being a fundamental long-term value in the end. So what we try to do is focus on buying cheaply, but address those risks by focusing on higher quality businesses, competitively strong businesses, and focusing very much on financial strength as additional important characteristics.
How do you come up with screens or lists to examine?
Well, we run typical screens that you would run looking at 52-week lows, of which there are almost none these days. Low price to earnings, low price to book, but we also screen on some of those quality metrics that we're also looking for, so financial strength, return on equity, those types of characteristics. And most importantly, we spend a lot of time on the road meeting management teams. We don't spend time talking to sell-side analysts. We don't spend time talking to pundits. We don't watch CNBC. We do all of our own independent work, and that means being out on the road, meeting with management teams in the local economies where the businesses operate.
That leads to an interesting question. Some, as you know, managers feel you just look at the numbers and that's sufficient. What do you get from management? What are you trying to get a feel for? Because after all, if they're going to let you in, they think they can sell you.
Sure. Yeah.
Razzle dazzle.
Yeah, absolutely. And a lot of them do try to do that. Management is one of the hardest pieces of the puzzle to assess, because they can be very promotional, and they have interests that can be different, certainly from ours as long-term investors. But fundamentally with management teams, we're looking for cultures and values and strategies that mirror our own. In other words, do the management teams act as owners? Do they have a long-term business perspective that's rooted in a fundamentally rational economic framework? And are their interests aligned with our own? If we go into a management meeting and they're talking about beating the street for earnings, if we go in to a meeting with management and they talk about doing deals because they're accretive to earnings because interest rates are so low, we immediately have red flags that suggest that these people are not behaving sensibly. They don't have a well-grounded, long-term, risk-oriented strategic framework and financial framework. But it is one of the hardest things to assess.
How difficult is it to get into management when you call up and say, we'd like to drop by?
Yeah. Well, it's a lot easier today now that we're managing, 30-something billion dollars than it was when we were managing 500 million, for example, if we go back 10 years. But it's not impossible, even if you have a small asset base, to get in front of management teams, if they're aware of your perspective. So I think management teams find it refreshing to sit down with investors who are not asking them about this quarter or the next quarter, who are thinking about the business over 5, 10, 15 years, who want to talk about competitive situations, who want to talk about strategic questions, who want to talk about how do you grow this business over the next 5 years. These are the things that good management teams focus on, and I think they're happy to talk about the business in that way with someone who's like-minded. But the 30 billion certainly doesn't hurt.
Challenges, U.S. versus overseas, more specifically developed countries versus developing countries in terms of trying to value.
Yeah. Well, the gap in information and the quality of information has certainly narrowed, over the last many years that I've been in this business. If I go back to the 90s, when I started doing this, and I wanted to value a company, and even in Germany, if it was a smaller or mid-cap company in Germany, it'd take you a couple of weeks to get the annual report. You'd have to send away for it. It might be in German. You might have to have some of it translated, and so on and so forth. And now, obviously, the information is instantaneous. It's on the website. So the transmission and availability of information, the gap, U.S. versus the rest of the world, has clearly narrowed, although in some parts of the world it does still exist to greater and lesser degrees. Now, putting information access aside,
what about the quality of the numbers?
That's right. Well, not just the quality of the numbers, but the quality of the management teams, the agency risk that's involved. So if you go to Japan, and many a value investor over the past 20 years has gone to Japan and has seen the valuations and has felt like they found themselves the holy grail, a business with net cash on the balance sheet, trading at a discount to book, and they failed to appreciate, without earning a few scars on their backs, the very different cultural values from a business standpoint that make it very difficult to realize the value of that investment, or the very different corporate governance standards in a place like South Korea, which would allow a large, high-profile company like Hyundai to invest $10+ billion in a piece of real estate that's unlikely to ever generate a return worthy of that price. So those are the types of challenges that continue to exist and persist, and I would say that they're probably greater than the access to information.
Finding value these days. How difficult is it? You have a pretty high cash position. Is that saying that the pickings are pretty slim right now?
Yeah, it is. So our cash positions are 10 to 14%, depending upon the strategy, and they reflect that very point. It is very difficult right now to find businesses that meet our valuation criteria. We've had years now of revaluation from the financial crisis, and stocks in general appear to us to be, for the most part, fairly valued.
Talk about lack of uncertainty.
Well, lack of uncertainty breeds complacency and optimism and breeds normalized to high valuations. And I think that's what we have. You know, it's interesting to think about the high valuations that we see and the sentiment that you reflect in your question compared to relative to all of the issues that exist out in the world today. And the issues that we've been facing over the last many years during the crisis, during parts of the crisis, before the crisis, are still to some degree present, and yet nobody's really worried about them.
And yet you don't get a feeling of the kind of bullishness you had in the late 90s or even before the crisis of 07, 08, 09, that there's still a lot of a wall of worry out there, or isn't there?
Well, I mean, if you go back to the 90s, you had one part of the market that was ridiculously overpriced and other parts of the market that were cheapish.
Right.
In many cases, very cheap. Today, I think you have a market that is generally fairly priced. In other words, there's not a pocket, not many pockets where valuations are depressed and other areas where valuations are extremely high and them aggregating to an average fair valuation. You have, in general, most businesses trading within a range of fair.
Now, the developing world, is that coming back to life? Or you mentioned in the past that you have real junk out there and you have companies that are quite pricey out there.
Yeah, I think it's difficult to find businesses that are of an attractive quality and of an attractive price. You can find some things that are statistically cheap, but aren't necessarily the types of businesses that we would want to get involved in. And
well, take Brazil, for example, which is now in recession. You'd think there'd be bargains galore, but you don't think there are.
Well, if you want to find a bargain in Brazil, you have to buy either a home builder or an iron ore producer controlled by the government with a lot of debt on the balance sheet, dependent upon exporting its iron ore to China, for example. So those aren't generally the types of businesses we would like to get involved with. The better businesses, the Naturas of the world, which is a consumer products company, or the Ambev of the world, which is a beer company, those are still very expensive.
Ambev going to buy Coca-Cola?
I doubt it.
So the developing world, you don't see much pickings there?
Not yet. Not yet. But we are ever vigilant.
Well, one area you seem to feel is underpriced somewhat is financial institutions. And explain that, and especially in the face that they're now in many ways utilities.
Yeah.
Politicians see them now as piggy banks to be picked almost every week, it seems. And I'd love to get your fix on how you see technology, alternative payment systems are going to do to traditional banks like Alipay.
Okay. Well, those are two questions. I'll address them separately.
So first, the bargains on financials.
Financials, it's very interesting. They are being treated as piggy banks. And I think in the United States, from the financial crisis through next year, roughly $300 billion in fines and regulatory damages will have been extracted from the major financial institutions. It's interesting to think about that number because if you leverage it, which is what bank capital is, it's something to be leveraged to feed the economy, we see a huge amount of economic activity that is being extracted from.
That'd be over $2 trillion.
Yeah. Well, if you do it at 10 times, you know, it's 3.
Yeah.
That's a meaningful number. So you're right. Huge amount of value coming out of that. And I think the regulatory assault on financial institutions is in part responsible for investors' depressed view of these businesses, which is creating a valuation opportunity. And I think also, to some degree, it's a sense of investors are fighting the last war. So the financial institutions were clearly, they went into the financial crisis very weak. They were bad actors. Their equity capital was in many respects destroyed, either entirely or partly. And investors don't want to go back to the future, so to speak. But that ignores the new reality that we have in this industry, and that is massively recapitalized financial institutions, equity bases that are multiples today of what they were in 2006, 2007. Higher quality funding mixes. So they're completely different businesses and much safer in my view, and the valuations are attractive.
Talking about Euro banks, European banks, you say they're deleveraged. You feel are much better shape than they were 3-5 years ago?
I would say that the U.S. banks are in far greater shape than they were and are in far better shape than Eurozone banks in general, which isn't to say there aren't some opportunities in Europe in the banking industry. We own 2 banks in the United Kingdom, and we own a Dutch financial institution called ING. I would say in general the European banks are actually not in good shape.
Which accounts for why they're not lending?
Yes, they still need to significantly replenish the quantity as well as the quality of their capital base.
And U.S. banks, lending activity doesn't seem to be that buoyant, at least judging from industrial and commercial loans.
Yes, I think part of that is demand, and I think also part of that is supply. We just talked about $300 billion being extracted from the banking industry. We're in a period where capital ratios and capital uncertainty around capital ratios persists.
Right.
So if you're running a bank and you have regulators every quarter extracting a pound of flesh out of your equity, and other regulators telling you your equity is not enough next quarter compared to what I said it was going to be last quarter, what are you going to do? You're going to husband your resources, and you're going to err on the side of having a conservative capital base, which means not providing capital to the economy.
You mentioned 3 financial institutions, or 2. There's a third, Royal Bank of Scotland,
Yeah.
Lloyd's, and ING.
Yep.
You still bullish on those 3?
Yeah, our largest position out of the 3 there is Royal Bank of Scotland, and that would be the one that we like the most. We think it's the most undervalued of the 3.
For the same reasons you said before, they've gotten their act together, but people still think it's 2008.
Well, in many respects, yes. I mean, Royal Bank of Scotland is probably the poster child for bad behavior leading up to the financial crisis. They did everything wrong that a financial institution almost everything wrong that a financial institution could be accused of doing wrong, and so they've been on a multi-year journey of healing the damage that they did to that institution. I mean, they have delevered from 2.6 trillion balance sheet. They've brought that down by over $1 trillion plus since the financial crisis. They have purged themselves of, this would be a pound sterling number, 750 billion pounds of toxic assets. So the deleveraging has just been tremendous in scope. But what we have now is a bank that's probably 75–80% through that process and is now coming back to what has always been the core of that business, and that is a very attractive retail and commercial bank in the United Kingdom, which is a very attractive banking market. It's a highly consolidated banking market, and consolidation in banking means structural profitability. And so you now have a bank that's got a very strong capital base, it's got a strong market position, costs are coming out, the toxic assets are gone, and you can buy it at less than tangible book.
Is it a downer that the government still owns the bulk of it?
It's
weighing over the market?
It's an upper if you're a buyer.
Okay.
Because I think that the presence of the UK government on the share register depresses the valuation. And when they will ultimately exit, and that will provide relief.
Technology stocks, you've mentioned in the past large cap. You still find those attractive?
We do. We own quite a few technology companies. Our largest positions would be Oracle, Microsoft. Qualcomm is one that we recently added. Cisco. We own some Google, and our largest
Samsung.
One of our other largest is Samsung. And I was looking at those. I was looking at a few of those today as I was thinking about the differences between U.S. companies and European companies, and valuations in Europe versus valuations in the U.S. And I looked at just 5 of those companies: Samsung, Microsoft, Oracle, Qualcomm, and Google. And between the 5 of them, over $200 billion of net cash on the balance sheet between the 5 of them.
Apple you like?
We owned it and sold it last quarter.
Alibaba and Baidu?
We do not own Alibaba. We do own Baidu.
Covidien, what do you see there?
Well, Covidien we own Covidien and we own Medtronic, and the two companies are about to merge and become one. They're both fantastic businesses in the med tech industry, highly profitable. Businesses are both growing, and when you put the two of them together, you're going to have a $850 million cost savings opportunity. I think it's going to end up being more like $1 billion when all is said and done. And you have the ability, because Covidien is a non-U.S. domiciled company, they're doing an inversion, and there's a lot of noise being made about inversions, as you know. But it's going to be very, very value creative for us as shareholders, because the tax rate's going to go down and the access to the trapped cash is going to increase.
Tesco, you've long believed in it. It got hit, but now you think it's coming back again?
Yeah, this goes back to my comments at the beginning about what we try to avoid when we act as value investors. Yeah, Tesco's been a terrible investment for us, but the past is past, and we are where we are today, and we think it's going to be a great investment going forward from here. So what Tesco is it's the largest grocery store operator in the United Kingdom, one of the largest, neck and neck with Carrefour across Europe. And it's facing a number of headwinds. It's facing the rise of hard discounters in the United Kingdom. It's facing excess capacity in square footage generally in the United Kingdom. And a weak economy has not helped as well. And then Tesco has some of its own self-inflicted wounds. But when you look at what Tesco is, you see the architecture, the foundation of a very powerful business that's been hampered by all of these issues that I mentioned. They have 28+% market share in the United Kingdom, which is about twice the next largest competitor. It's a very well-known brand, albeit one that's a little bit tarnished right now, but a very well-known brand. Its size, its scale, its distribution, its logistics, its internet operations, all of these things are very, very valuable structural advantages. And we think with the new CEO, David Lewis, in place, he will operate that business better. And in several years, you will see a much more highly valued business. It's very interesting. I was reading the Best Buy results from yesterday, and I was comparing the valuation of Best Buy to Tesco. Now, Best Buy, as you know, sells electronics.
Right.
And that is an industry that is clearly under pressure from the internet, has all kinds of questions about the long-term viability of selling an increasingly commoditizing set of products. And the valuations of Best Buy and Tesco from an enterprise value to revenue basis are identical, which shows you how depressed the valuation of Tesco is.
Any others excite you?
Qualcomm. Qualcomm, I think, is a very interesting stock. Samsung is very interesting. I can talk about both of those. Samsung, as you know, is a electronics manufacturer. They have a semiconductor business, they have a display panels business, they have a consumer electronics business, and they have a mobile phone business, as you know, and a huge pile of cash, $50 billion some dollars of net cash.
How are they as innovators?
They're good innovators from a hardware perspective. They're not in the software business. Their strengths, I would say, are on hardware design and manufacturing efficiency. So they were nowhere in the semiconductor business if you go back many years, and because of those skills that I just mentioned, they've become a dominant player in different parts of the semiconductor business. In handsets, they've developed an incredible handset business over the past 10 years on the back of ruthless cost focus, great distribution strength, great scale, vertical integration, and really innovative hardware design. But the software, of course, is Android software, so they're not in that business. But if you look at the valuation of Samsung, you're basically getting the handset business for free right now.
And Qualcomm?
Qualcomm is the dominant owner of intellectual property that's used in smartphones. And it's a highly profitable business, has about $30 billion of net cash. Market cap's around $115, $120 billion. Trades at around 12 times earnings, excluding the cash. And the story with Qualcomm is that every time a 3G or a smartphone, 3G and increasingly 4G smartphone gets sold, Qualcomm gets a royalty on that sale. And given that smartphones are only 50-some% of global handsets sold today, that penetration will inevitably increase. Qualcomm is facing a long time horizon of growing smartphone volumes and therefore a growing royalty stream and growing profits. Now they're facing some issues in China. This would not be a surprise to any investor who's familiar with the lack of enforcement of Chinese intellectual property rights. And they're basically, Chinese handset manufacturers are not paying Qualcomm the royalties that they are owed. So Qualcomm is in the process of trying to get these companies to honor the intellectual property rights that Qualcomm has. That's why the stock has become cheap. We think that that will ultimately prove to be a short-term issue, and the long-term merits of the business, the capital allocation, and the balance sheet will ultimately result in a much more highly valued security.
Thank you very much, Dan.
Thank you for having me, Steve.